Here's a question I want you to sit with for a second. If I told you there was a number, one single number, that is quietly reducing the pension payments of hundreds of thousands of Australian retirees every single fortnight, and that almost none of them have ever been told what that number is, would you want to know it? That number isn't $250,000. That's the one you've probably heard. That's the bank safety figure, how much the government guarantees per institution if a bank goes under. And yes, it's worth knowing, but it's not the number that's costing retirees money right now. The number that matters, the one that actually hits your fortnightly Centrelink payment, is $321,500. Stay with me, because by the end of this video, you'll understand exactly what that figure means, why it matters more than anything your bank has ever told you, and what two separate Centrelink assessments are doing to your retirement income every single fortnight without a word of explanation. My name's David Hartley. I spent just under 35 years in financial planning and tax advisory across Sydney and regional New South Wales. Individuals, self-managed super funds, estate planning, Centrelink matters, ATO reviews. The whole picture. I retired from practice in 2023, and I started this channel for one reason. The same problem kept showing up decade after decade in almost identical form. A retiree in their late 60s, careful with money their entire working life, a solid cash balance, and absolutely no idea that the assets test was reducing their pension every fortnight silently, while their bank said nothing, their super fund said nothing, and in a lot of cases, even their accountant had never raised it. The gap in their knowledge wasn't $250,000, it was $321,500. Let me show you exactly why. Most Australians approaching retirement have heard some version of the $250,000 rule. Spread your savings across multiple banks, keep under $250,000 per institution, and your money is protected under the financial claims scheme if a bank collapses. And that's true. That's correct advice. It answers a genuine question. But here's the thing. Australian banks almost never fail. In nearly 2 decades since the FCS was set up, the scheme has been triggered once, for a small institution most Australians had never heard of, not a major bank. The risk that advice is protecting you against is real in theory and essentially non-existent in practice. The risk that nobody is talking about, that's happening right now, every fortnight, to people with healthy savings balances who did everything right. Because Centrelink doesn't care which banks you've split your money across. They don't count your balance per institution. They add up every single dollar, every savings account, every term deposit, every accessible financial asset, and they assess the total. Full stop. You could split $500,000 across 5 banks, completely FCS compliant, at everyone. Centrelink sees $500,000 in assessable assets. 2 different frameworks, 2 different agencies, both looking at the same money, and only one of them is ever discussed at the kitchen table. So let's talk about what the assets test actually does. As of March 20th, 2026, a single homeowner can hold up to $321,500 in assessable assets and still receive the full age pension, currently $1,200.90 a fortnight. For a couple who own their home, that combined threshold sits at $481,500. Your principal residence doesn't count. That's exempt. But everything else does. Savings accounts, term deposits, shares, managed funds, and critically, your superannuation balance once you've reached pension age. All of it gets assessed. Now here's where it gets expensive. For every $1,000 of assessable assets above those thresholds, your pension is reduced by $3.00 a fortnight. The taper rate. Sounds modest, right? Let's run the numbers. Say you're a single homeowner with $450,000 sitting across savings accounts and term deposits. You're above the $321,500 threshold by $128,500. Divide by 1,000, multiply by 3. That's $385.50 less per fortnight. Multiply that out over a year, you're looking at roughly $10,000 in pension payments you're not receiving. Not because of bad luck, not because of a market crash, just because of the size of your bank balance. And nothing on your bank statement explains it. No line item, no footnote, just a Centrelink payment that's lighter than it should be every single fortnight, while the bank keeps paying you interest and calling it a great rate. Now, and here's the part that genuinely surprises most people, that assets test is only the first of 2 assessments Centrelink runs on your finances. The second one operates on a completely different mechanism. It's called Deeming. And if you've never had it explained clearly, you're not alone. Most articles about retirement savings either gloss over it entirely or describe it in a way that makes people's eyes glaze over. Let me try a different approach. Centrelink doesn't look at your actual bank statements. They don't tally up the interest you earned last financial year. Instead, they apply what's called a deeming rate, a standardized assumed rate of return, to your total financial assets, and they count that notional figure as income for the purposes of the income test. Whether you actually earned that or not is beside the point. The deemed figure is what gets assessed. From March 20th, 2026, the deeming rates are 1.25% on the first $64,200 of a single person's financial assets and 3.25% on everything above that threshold. For couples, that lower rate applies to the first $106,200 combined. These rates were frozen at lower levels for years, and then they rose in March 2026, which quietly increased the income test burden for part pensioners who didn't see it coming and haven't recalculated since. Let's use the same $450,000 example. Centrelink deems the first $64,200 at 1.25%. That's $800 and 2.50. The remaining $385,800 at 3.25%. That's $12,538.50. Total deemed income, just over $13,340 a year, roughly $513 a fortnight. The income-free area for a single pensioner is $218 a fortnight. Above that, the pension reduces by 50 cents for every dollar of deemed income. At $513 of deemed income, you're $295 above the free area. Income test reduction, $147.50 a fortnight. Now here's how the two tests interact. And this is the piece that most people have never seen explained. Centrelink calculates your entitlement under the assets test and under the income test separately. Then they pay you whichever produces the lower payment. Whichever test hits, harder wins. In our example, the assets test cuts your pension by $385.50 a fortnight. The income test cuts it by $147.50. You receive the lower payment, meaning the higher cut applies. The assets test wins. Both tests ran. Only one shows up in the outcome. But if your circumstances change, if you draw down your assets, or if deeming rates shift, the income test can start doing more damage. Both numbers matter. At this point, someone usually raises an objection, and it's a fair one. My savings account is paying 4.5% right now. Centrelink is only counting me at 3.25%. So surely I'm ahead on the income test. For the income test in isolation, yes. If your actual earnings exceed the deemed rate, the income test is using a lower figure than reality, and that does work in your favor. Partially. But the assets test doesn't care what your account earns. It cares what your account is worth. The interest rate on your savings is completely invisible to the test that's doing most of the damage. And then there's the ATO. The ATO runs its own assessment entirely separately, using actual figures, not deemed ones. Every dollar of interest you earn at 4.5% appears on your tax return at 4.5%. Three separate calculations on the same balance, none of them talking to each other. For most retirees, the ATO's assessment is softened, at least partially, by something called SAPTO, the Seniors and Pensioners Tax Offset. For the 2025 to 26 financial year, SAPTO is worth up to $2,230 for an eligible single retiree. Stack that with the standard tax-free threshold and the low-income tax offset, and an eligible senior can earn up to around $34,900 before paying a cent of income tax. That's nearly double the standard threshold. A meaningful concession. And one that a lot of retirees either don't know they qualify for or don't realize they're slowly eroding. Here's how the erosion happens. SAPTO phases out as income rises. Above that $34,900 shading out point, the offset reduces by 12.5 cents for every dollar over it. By around $52,750, it's gone entirely. Bank interest sits right in that phase-out band for a lot of retirees. Say you've got $400,000 in a high-interest savings account at 4.5%. That's $18,000 of interest income a year. If you've also got a modest super pension running in the low to mid-30s, that $18,000 lands squarely in the SAPTO phase-out zone, generating a tax liability that simply wouldn't exist if that money was structured differently, not catastrophic in any single year, compounded across a 15 or 20-year retirement, a real number and the bank that paid you the 4.5% has no particular reason to mention it. Now I want to talk about a version of this problem that's sharper still, and that affects a group of retirees who often assume the rules don't apply to them. Self-funded retirees, people who aren't receiving the age pension and don't think Centrelink is relevant to their situation. There is a benefit specifically for this group, the Commonwealth Seniors Health Card, and it is one of the most underused senior entitlements in the country. The CSHC is available to Australians over 67 who don't receive the age pension. It's income tested only, no assets test. And the thresholds as of September 20th, 2025, are $101,105 per year for singles and $161,768 combined for couples. Those numbers are higher than most people expect. A lot of self-funded retirees who've written off the CSHC as something they'd never qualify for are either under those thresholds or close enough that it genuinely deserves a look. The card delivers cheaper PBS medications, significantly better odds of GP bulk billing, and a range of state government concessions that add up considerably over time. Here's where the structure of your savings becomes critical. For the CSHC income test, Centrelink uses adjusted taxable income, your actual reported income from your tax return, and bank interest is counted at the actual rate. Real dollars, not deemed ones. Say you're a self-funded retiree with $600,000 in a high-interest savings account earning 4.5%. That's $27,000 of bank interest on your tax return. If your other income, a super pension, some dividends, is already sitting around $80,000, that extra $27,000 takes your total to $107,000, over the $101,105 threshold. The card is gone. Now consider the same dollars, earning the same return, held inside a superannuation accumulation account instead. The earnings sit inside the fund. They don't appear in your adjusted taxable income. Centrelink isn't counting them. The ATO isn't attributing them to you personally. For the CSHC income test, that money is essentially invisible. Same dollars, same return, different structure, completely different outcome. I want to be clear. Restructuring your finances is not a decision to make based on a YouTube video. The rules around super contributions after 67 have their own layers of complexity, and what's right for one situation won't automatically apply to another. A conversation with a licensed financial advisor who understands aged care, Centrelink, and super interaction is the appropriate starting point. What I am saying is this. Where your money sits determines which income tests it triggers. That's not a strategy. That's basic knowledge. And for self-funded retirees sitting near the CSHC threshold, it's potentially the knowledge that keeps an extremely valuable card in your wallet. Let me say something plainly that nobody in the financial services industry has any real incentive to tell you. Your bank has no interest in explaining any of this. Their product is working exactly as designed. The interest they pay you is their cost of holding your money. What the assets test does to your Centrelink entitlement when you park $450,000 with them is simply not their business model, and it will not come up in a branch conversation or appear in a product disclosure statement. They're not doing anything wrong. They're just not doing this. The advice industry is supposed to close that gap. Sometimes it does, but the retirees who get hit hardest by the assets test, people sitting in the $300,000 to $600,000 range, just above the full pension threshold, losing several $1,000s a year, are often the ones who've decided they don't need a financial advisor. The balance doesn't feel large enough to justify the fee. Sometimes that instinct is right, and sometimes what they don't know is costing them 5 or 10 times what advice would have run. Here's something that does exist, costs nothing, and is genuinely useful. Services Australia runs a free financial information service. FIS officers are specifically trained in how Centrelink assesses assets and income. They can sit down with your actual numbers, map them against the current thresholds, and show you exactly where you sit under both the assets test and the income test. They won't tell you where to move money. That's licensed advisory territory. But they can give you a modeled number, not a general estimate. A real figure showing what your current balance is costing your pension right now. If you're near a threshold and you've never had that conversation, that is where to start, not the bank, the FIS. Book through Services Australia. It's free. It's specific to your situation. And it's the first step to understanding a number that most retirees never get shown. Before you close this video, here's one thing I'd like you to do. Pull out your most recent tax return and find the interest income line. That single number tells you the footprint your bank balance is making with the ATO, and it's a reasonable first indicator of whether the assets test deserves a closer look. If the interest income line is meaningful and you're at or near pension age, the next question to ask is, where do my total assessable assets sit relative to $321,500 if you're a single homeowner, or $481,500 for a couple? Those thresholds are updated every March and September. Above them, every $1,000 in the bank is reducing your pension by $3.00 a fortnight. Below them, you're in full pension territory. That's the line worth knowing, and it's worth checking more than once. Everything I've covered today is general information drawn from my years in practice. I'm not your financial advisor, and the numbers specific to your situation belong in a conversation with either a licensed advisor or a free FIS appointment through Services Australia. The specific question to bring to that appointment: can you show me exactly how my assessable assets are affecting my pension under both the assets test and the income test? That question gets you a modeled answer, not a general one. And a modeled answer is where real decisions start. If a Centrelink review has ever come back lower than you expected, or if you've just realized for the first time that two separate tests are running on your savings every fortnight, I'd genuinely like to hear about it below. Take care, and I'll see you in the next one.